So I'm going to go over something today which is somewhat obvious, but I still think it's understated. Why do PE ratios matter so much? And the reason the price to earnings ratio matters so much is because essentially it's how much are you as an investor getting paid for taking on that risk. The business, for example, if it has a PE ratio of 5, means that, which is very low by the way, compared to historical averages, means that it takes 5 years for the business to pay itself back. Therefore, you're getting paid effectively 28% a year for holding this business, assuming there's no real change to the fundamentals. So if you're getting paid 20% a year for that, for holding that business, that's pretty good when you compare it to other things. So what do we realistically have it to compare it to? Well, you have a bank account, but then what else do you really have? You have treasury bills. So quite often it's about the treasury bills as well. So for example, treasury bills um, in America at the minute are sort of yielding about 5%, 4%, right? So if you know you've got a company that's making 4 or 5%, a treasury yield that's making 4 or 5%, or B, you've got a business that you can invest in that makes 20% a year, which you're going to take? Well, it might not always actually be the business, because the business might have a lot of risk to it. There might be a lot of downside. It might own a lot of debt, and you're not comfortable holding that. Whereas you might be with the treasury, and you might have different goals. But if the businesses are decent risk and you want to take on a bit more risk and you're happy to do so, and the downside is sort of protected because of certain instances, they might hold a lot of cash, not much debt, on the balance sheet is strong, the management is run well, there's a long track record, then actually you might think, well, actually, what am I doing, and why I should buy this 20% returning a year business. And that's essentially what the business is at a fundamental level. Now, stock prices don't always follow this, but that's essentially what the PE ratio is. And that's why it's such a big metric in investing. Now, you sort of look at indexes and you can sort of see that, oh, well, actually, they've got a P ratio of about 25 at the minute, meaning that actually you're only making about 4% on your money per year if you do the maths behind that. Whereas if you have a treasury bond or something like that, you could comfortably be making about 4.5% a year, and which has lower risk historically. Well, actually, it's the treasury bill that has lower risk historically. So why would you? It sort of begs the question: as an index fund investor, if you just invest in index funds, why would you currently be investing it at the minute? It doesn't make sense. It's better to switch over to treasuries, and that's sort of what has been, and it's often used as a metric essentially to sort of predict crashes, and it has been somewhat effective in fairness to it. And I think that's why you should take into account the P ratio. That now you have some super investors like Monish Babrai, who he has this concept of the hidden P ratio of 1, meaning that he actually looks for businesses which have a P ratio of 1 in some way or another, or pay itself off in a year and a half, 2 years, something like that. And that's another path that you could go down. But I do think if you're not even going to go down that path, I think that there is something to say there for it. There's many times where you have rapidly growing businesses, but what does that mean if they're trading at P ratios of, I've seen it's like in the thousands, then how are you going to benefit off that in the long term, and when will that growth tail off? So I do think it's something that's often underappreciated for even as big as it is, because essentially it's all about your risk, your return, and the probability. And so I think that's something to consider when you're taking an investment, and looking at historical averages helps, but also sort of what yield, what amount are you looking to get back as an investor every year. Now, if you got told you'll make $1 today, but next year you're going to make $1.50, well, actually, you'd be willing to pay a bit more for that, wouldn't you? So it's taking that into account, balancing it, and your judgment at the end of the day. But I do think it is still understated with even how big it is. Thanks for listening.